everybody. My name is Carlos Guerra. I'm the Chief Executive Officer of Innova, and today my team and myself are going to give you a presentation regarding the performance of our company over the last 4 years.
Hi, my name is Eric Portillo. I am the CMO of Innova Enterprises. Today I'm going to be speaking about the functional strategies of our company.
My name is Angelica Donahue and I'm the CFO of Innova Enterprises. I'm going to be talking to you guys today about the financial statements from year 5 and year 6.
Hi, my name is Jenny Vaughn and I am the COO of Innova Enterprises, and today I'm going to be discussing the statement variances and the peer comparisons.
Hi, hello everyone, my name is Eileen and I'm the CIO of Innova Enterprises. Today I will be discussing about Innova's SWOT analysis.
Hello everyone, my name is Erica Ariano and I'm the controller of Innova, and today I'm going to be speaking of our future plans into year 7 and also doing a little bit of compare and contrast as to what the strategy we used and what we could have done differently to produce better results.
Okay, so as an agenda for our presentation, we're going to start off with a brief introduction about our company and our business. We'll go into the performance objectives set forth in the 2-year plan, discuss how we performed relative to our targets. From there, we'll go into our functional strategies. From there, into a peer comparison, which will compare our metrics against the other competitors in the industry. After that, we'll go into a pro forma variance analysis, which will discuss year 6 target versus actual performance. From there, we'll go into a SWOT analysis on our company, then into a future plan for year 7, and we'll finish it up with a lessons learned section. So, an introduction. Innova Enterprises was founded in 2008. We're a global leader in manufacturing, marketing, and selling consumer durable goods. In year 6, we realized revenues of a total of $32.7 million, which was an 11% increase from year 5. And 115% increase from year 3 when new management took over. So at Innova, our vision is we seek to grow the Innova brand into a household name synonymous with innovation and value. And our mission to accomplish that is to leverage the technological innovation to provide cutting-edge products to middle market, value-conscious consumers. So, being that Innova is an international company, we operate 2 segments. The first being our domestic segment. We are an American company. We're headquartered in America 2. We also have subsidized sales offices in markets areas 1 and 3 in America also. And in America, our revenues are generated from sales directly to consumers and also to any of our affiliates. And our home plant in America currently operates 8 lines, and we often schedule second shifts and overtime hours to meet demand. And as far as our product positioning, we differentiate our product. It's very adaptive to each market. So in America 1, we are selling a deluxe quality with enhanced features. America 2, standard quality with standard features. And in America 3, we're selling standard quality with basic features. So for our international segment, as was mentioned, we were an international company since its inception in 2008. But prior to year 4, we operated purely on exports to Sereno. And in year 4, quarter 1, is when we actually began the construction on our second plant in Sereno. So in Sereno, revenues are generated through sales to consumers and affiliates, similarly to our domestic segment. And in our Sereno plant, we're currently operating 4 lines, and the product positioning, similarly to our American product mix, we adapt it to what the consumers prefer, and that is a deluxe quality with enhanced features. So the purpose and the scope of this report, the purpose is to assess the strategic decision making under current management, and the way that we're going to do that is we're going to analyze Innova's performance relative to goals and objectives set forth in the 2-year plan, and we'll also compare those to our industry competitors. And so for the scope of the report, it's going to cover the financial performance for years 3 through 6. We're going to analyze our performance as well as industry competitors' performance. And the scope will also be talking about the decision-making processes that we use in our company. So for our performance objectives, our performance targets versus our actual, this chart here will show you what our targets were and what the actual values were for each year. As I go into each metric, I'll discuss it a little bit further. Okay, so for our performance targets versus our actual, on our return in assets, year 5 target was 1.7%, and our year 6 target was 4.9%. We performed pretty well. Our actual for year 5 was 5.3, and our year 6 actual was 6.5. So we exceeded our target values for ROA. For return on equity, our target for year 5 was 2.9%, and year 6 target was 3.7%. As you can see, similar to ROA, we performed very well. We exceeded our target. Actual was going to be 8.8% for year 5, and year 6 was 11.8%. So for our market share, it was undoubtedly our strongest performing metric. In year 5, our target was 31.2%. In year 6, target was 35%. Our actual performance, our average year 5 market share was 26.6%, and in year 6, 26.5%. And although we didn't meet the target values for market share, we still performed very well, and we're actually the leading. We have the leading market share. So for stock price, our year 5 target was going to be $2.36. Year 6 was $4.13. Now, how we actually performed in year 5 was slightly lower than what we set as a target at $1.96. Our year 6 actual was $2.95, which was substantially lower than the $4.13. Although we didn't meet the targets, we still had increases quarterly and year over year, so we were pleased with that performance. Now for the unit production cost, our target for year 5 is going to be $5.10. For year 6 was going to be $4.50. We believe we're going to be able to reduce the cost over year 5 and 6 to produce each unit. However, our actual unit production costs did increase to year 5 and 6, so we did not quite meet the target unit cost. That could be partially because of the more expensive labor in America, and also the necessity to schedule overtime hours as well as second shift lines. And so for our net income, we set a year 5 target of $3,398,400, and in year 6 was $8,042,000. And our actual performance was pretty low compared to our target. In year 5, we realized $2,683,000, and where in year 6 we got $3,508,000. We didn't hit the mark on our total net income targets, but they were a bit optimistic and a bit aggressive. So although we didn't meet our targets, we still increased from years 4 to 5 and from years 5 to 6.
Okay, to begin with, I'm going to be speaking about the functional strategies of our company, Innova. Innova's strategic intent from its conception was to deliver quality consumer durables at a good price. The company's leading managers and executives designed a solid business plan for the consumer durable market, which combined with an eloquent marketing, operations, financial structure, illustrated the success that we are as Innova. Planned versus actual numbers in our marketing. The table that you're going to see in a couple slides will illustrate the following numbers because they display Innova's business approach. In producing the right product, price must complement the product, and Innova's achieved this through intense research each quarter. We remain competitive with our pricing, as well a low price leader against our rivals in order to maintain our market share. Satisfied with our pricing, we took into consideration the morale of our staff at all levels of the business. We increased salaries, provided higher commission base, which in turn increased our unit sales. The more interest we gave to both our internal and external factors, the better Innova operated within the market. Once we understood this dimension, we began to advertise more aggressively to meet the demand of our business, increasing our overall performance each year. The only inconsistency is seen in our unit sales, a variable that was analyzed and strategized quarterly based on our competitive market share and the demand for the product, which was easily affected by those variables. Overall, the table reflects that Innova's initial projection is accurate and allows us to remain competitive with our quality and good pricing. This is the table. We have our product price, number of salespeople, salary levels, commission rate, advertised spending, and unit sale. This is the projected plan for year 5 and year 6. Versus this is the planned and this is the actual. As you see, all of them are pretty much in line and parallel to each other. Like I was saying, our only inconsistency is in our unit sales. Slight variance towards the end in Sereno. And next. So planned versus actual numbers in our operations and production management. For this strategy, we cultivated our vision, mission, and we began to focus on our growth as a company. The team derived their data through statistical inferences, Excel spreadsheets, and research tools within our gamebook. The operational planning focused on implementing our strategic intent of producing and delivering those quality goods that our consumer base wanted. We analyzed the trends of each area through consumer buying preference studies, sales force data, and our rivals and our individual sales per quarter. The expansion of our business is illustrated in the following table, which you will see. We are illustrating only key information to support our operation plan. This data should demonstrate the direction and the growth strategy we wanted to take the company. The plan versus the actual in this table are fairly accurate according to our 2-year forecast. Our overall performance remained consistent in this department, especially because our decision making was in line with our forecasted growth. The only inconsistency that is visible in the table is the unit sales office, where it appears that we shipped more products than what we had originally planned. This can be analyzed by our inventory data, where we can deduce that we supplied more products simply to meet the demand. Our increased storage expense is also based on this, the leftover product per quarter, a variable that is also identified within the market competition, the sales per given area, and the transition between models. And this is our operations and production management. This is year 5 and year 6 are planned and are actual. R&D was consistent. Our model introduction remained consistent. Training expenses were fairly online. Cost savings, we increased our cost savings. Inventory is a little inconsistent, but we remain within the margins of our numbers. And then the inconsistency I was speaking about was our total unit sales offices in the office. Large gap in variance between what we had planned and what we actually generated. Next. Lastly, I'm going to be speaking about our financial management. Using a system of strong internal controls, Innova followed our financial statements like a treasure map. We generated financial data quarterly for the first 2 years, year 3 and 4, in order to project our 2-year plan for year 5 and 6. Having developed our decision making as a team from the beginning of the game, we were able to encompass a strategic objective of how we wanted to diversify our gains and losses. Intent on delivering quality goods at a reasonable price, we set out to bargain and negotiate with the market in order to increase market share and profit. The following table is an analysis of Innova's financial approach. It is derived from Innova's financial decision making from the last 2 years. Here, we will illustrate the skill set that our financial wizards used in order to generate income based on the fluctuations of economic variables within the framework of our competitive market. Bonds and stocks were issued and repurchased as a strategic tool to generate cash for our increased operations in Sereno and to account for increased lines within our home area. The two financial backings proved to be lucrative at the end of each year, providing us with the income to satisfy our growth. Overall, our 2-year plan was in line with our financial objectives in year 5 and 6, avoiding the common pressures of the market and the competition. We kept well in line with our strategic objectives as seen in the table, and we delivered not just to our investors, but to ourselves as an investment within the market of our consumer durables for the future of Innova. And this is our financial management. This is broken down per quarter for year 5 and 6, planned versus actual. We did not require any loans, which is a positive for us because we manage our finances accurately accordingly to our decision making. We did issue bonds and we did issue stock. Dividends were paid out to our investors, and at the beginning of year 6, we began to do incremental payouts within our dividends. And this concludes our strategic functional strategies.
So for the financial statements, I pulled out some highlights that we could talk about. First of all, the net sales. We saw an overall increase in net sales from year 5 to year 6. Our net sales in year 5 were $29,431,000, and in year 6 were $32,726,000. And then in quarter 2 and quarter 4, we consistently had higher profits in those quarters. And selling expenses we had an overall increase in year 5 to year 6 as well, and that's some of that is due to our consistent increase in advertising every quarter, and our general increase in sales commissions over that 2-year span. Our net profit before tax also increased from year 5 to year 6. Our net profit before tax in year 5 was $4,368, and in year 6 was $5,750. Our cash in year 5 was $10,758, and in year 6 was $12,177. And obviously it increased from year 5 to year 6. But in cash flow, we saw an increase in year 5, but a decrease in year 6. That might have had something to do with our financing expenditures. This is just a quick snapshot of our expenditures in year 5 and year 6. For dividends in year 5, we did 400. We paid out 400. But in year 6 we paid out 675, so we were increasing in dividends as well, and dividends paid. And our stock. The reason that the financing cash flow is so much higher in year 6 is because our stock repurchase got a lot more aggressive in year 6. Year 5 we only bought back 478, while in year 6 we did 2,500.
For the income statement variances, we found that advertising expenses were 31.3% higher because we chose to aggressively focus on advertising our products in order to increase sales. For the training expenses, we found a variance of 61.3%. And this was due to us investing in Serrano in order to increase efficiency in the production process. Storage expenses were 140% higher. As we were the leader in the market shares, our increases in unit sales led some of our areas to experience unexpected shortages. So we increased the amount of inventory we stored in order to prevent potential stockouts. In reference to our foreign currency adjustment, we had a variance of over 1,000%, which was due to a miscalculation in the translation of the exchange rate. For the balance sheet variances, we found that cash balance had a variance of negative 39.6%. This was due to the negative net cash flow, which was affected by the increase in production costs and increases in our financial cash flow. Inventory also varied by 33.9%, and this was due to the unexpected drop in sales we experienced in year 6, quarter 4. For the cash flow statement variance analysis, we found that taxes paid had a variance of 32.6%. More taxes were paid due to Innova receiving more from accounts collected. Regarding our net operating cash flow, we had a variance of negative 50.9%. The main factor contributing to this difference was the increase in production costs during quarter 4. Our dividends paid and stock repurchased varied by 68.8% and 733% respectively. These numbers were larger because we decided to increase contributions in these areas in order to help increase our stock price. Our bonds repurchased were less than forecasted and had a variance of 40%. We decided to be more conservative in repurchasing the bonds due to an increase in cash flow towards dividends and stock repurchase. All of these decisions and factors also contributed to the cash balance ending variance, which was a negative 39.6%.
Alright, so first off, we're going to start off with Innova's strengths. First, I'd like to mention that I can proudly announce that Innova is in fact the market leader of the industry so far, and we've been ever since year 3. Some of our other strengths include that we also have consistently generated high amounts of sales, and we also have a high amount of assets in comparison to other companies. Next, I'd like to discuss some of our weaknesses as well. Some of our biggest weaknesses include that we have relatively low profit margins as a result of trying to stabilize our position as a market leader. And some of our other ones include that especially in year 6, we have faced low stock prices, lower earnings per share, and we also had occasionally incurred large amounts in inventory, especially during year 6. And we also face a number of opportunities as well. Some of our biggest opportunities include that we can create a larger international coverage overseas in Sereno by adding some more additional lines to our existing plant there. We can also purchase and utilize more of our market research studies. That way we can forecast in the future to predict for consumer demand and preference. And we also can increase our economic growth domestically and overseas in order to increase consumer purchasing. And lastly, we also face a number of threats as well. Our biggest threat is, of course, we exist in a highly competitive industry where our competitors actually have their own set of objectives and their own specialties to put an edge over their competitors. And we also have the recurring threat of facing sales force resignations. And we also have to account for changes in consumer preference of demand and products. And next we have Erica to discuss the future plans and lessons learned.
Okay, so the first thing that we would like to do into year 7 is increase market share in Sereno to produce a higher demand in that area, since that was our weakest market. We also would like to move the majority of our manufacturing into Sereno due to the low cost there, and it would also improve our profit margin. We would also like to eliminate most of our long-term debt to improve our financial ratios. And we plan to strategize for a profit margin increase of 20% going into year 8. We will be implementing and planning a new strategy for year 7 to accomplish this. We also would like to see net income to be 50% of sales, and that along would also improve our profit margin. There's a few changes that we will be implementing in order to achieve these goals in the future plans. The first thing in marketing, we are going to do more research in the market area there to learn our target market and therefore increase our market share. We're also going to be increasing R&D along with market share. So the higher our market share gets in Sereno, the more we're going to be investing into research and development. We also, since we have such a great workforce and they've been really good to us in producing a good outflow, we plan to increase commissions with every 5% increase in market share. As far as production goes, we anticipate an increase in demand in the future coming years. So we do anticipate to increase production in Sereno by expanding the Sereno plant and opening up new lines. Like I said before, we are going to be moving most of our manufacturing in Sereno, and that again is going to be to improve our profit margin. and we're going to be continuing to keep a safety stock of 25%. As far as financials go, we need to implement a new plan for cost management. In these few years at Innova, our first years, we wanted to create a stable market base. And now that we have the market base, we do want to do a little bit of cost management and be able to pass on the cost of producing a higher end product to our customer. This will also help us improve our financial ratios all around. We also want to produce enough cash flows to support operations each quarter. We would want all our expenses to be paid from that current quarter's cash flow. That way we can eliminate any borrowing and any long-term debt.